Hi, everyone. This is Rohit from Lifestyle Mastery, and today I'm excited to have Jan Thomas, who's a founder of Otto Finance, which gives you access to a personal financial coach and helps you to manage your finances, mortgages, pensions, and related topics. Otto is a B2B2C FinTech company, which is backed by Flash Ventures and is founded by London Business School, Bain and Morgan Stanley alum. Jan has also worked as a consultant in Bain and companies like Morgan Stanley and Deposit Solutions. He's done his MBA from London Business School. A big thank you to James Lowe from Manna for the introduction. Welcome to the show, Jan. Yeah.
Hi, it's great to be on board today, and thank you for the invite.
Yeah, no, absolutely. You have an interesting career. You know, you're from Argentina, and then you moved to you've been in the London ecosystem for quite some time, and you've worked in Bain and Morgan Stanley. How did you get into the world of startups, and what got you interested to build Otto Finance?
I think that's a great question. I think so. I started my career in management consulting, and then went over to do an MBA. I basically did. I actually wanted to stay long term in consulting. I had an amazing career and a lot of fun. But I needed a break. So the 2-year paid holiday at the MBA was a great option. So I went over to do that, and then over the summer I felt like, okay, I was always looking for new challenges and kind of like never staying in the comfort zone. And so when I was at the MBA, I was like, I mean, I could have done no summer at all, but I was like, okay, what's the one thing that is actually tougher than consulting? Basically investment banking, right? So I said like, okay, let's try that out over the summer, and I did that. I joined in Morgan Stanley, and I specifically joined the tech team, which was exactly what I was interested in, to do, like to see what it feels like to actually do like tech deals, and especially with being in London, where so much is happening, and you're basically the center for or the headquarters for EMEA, right, for a massive region where a lot of like tech deals happen. And so I remember like I had an amazing deal over the summer. We were basically on the sell side of a gaming company that was trying to sell the app for $1 billion approximately. So basically doing all that valuation and the road trip with gaming companies both in China and the US to sell it to big gaming companies, or even production studios and so on, has been incredibly fun. And then so basically I said, actually I need to try this a little bit longer. So I joined Morgan Stanley full time, and was lucky enough to be exposed to a lot of like really interesting tech deals. But at some point I realized that every time I was in a meeting with a client, with a tech client, I realized I was on the wrong side of the table. For example, when I was doing the IPO of a big cybersecurity company, and we were like in these drafting sessions with the CEO and then the leadership team, and you're building, in these drafting sessions, you're building the equity story to then present that to investors, right? To do the IPO, to do the book building of the IPO. And I realized, I mean, I was really on the wrong side of the table. I wanted to be on the side of the tech company, actually building an amazing company, like getting the equity story right, to then get more funding to get to the next stage of growth of the company. So I said, like, I need to try this out. I need to be on the other side, and that's why I decided to join a German scale up, basically, that had been doing super great in Germany and in continental Europe. So, and had just done a big funding round with top investors like the founder of PayPal and some really top growth equity funds in Europe. So I joined basically to help to build out the businesses for the UK and Ireland, the second biggest market in Europe after Germany. And that has been an incredible journey over the last couple of years in terms of really learning what it takes to like help build it, like to help take a company from A to B. And after that, at some point, I said, okay, now I run out of excuses. I built my network. I know what it takes to build a team, to like work on operations, on business development, on marketing, on human resources, and so on, and actually do B2B business development. So I ran out of excuses of like trying something of myself, which is something I always kind of wanted, right? It was always a niche that I had, and that I definitely felt it was the right time to scratch. And so I started conversations with potential investors, especially incubators and pre-seed and seed VC funds. And then I basically picked the one that I liked the most, and then we did the funding round and started building, and it has been an incredible journey so far. I think there is always stuff that looking back you would have done differently in terms of, hey, we could have done this more efficiently, or we could have avoided this or that. But at the end of the day, that's just part of the journey, that learning, and that's exactly what's also like so exciting, right? I mean, the uncertainty, the knowing that everything that you put into the business, every minute that you work on that, or every creative session or brainstorming session you have, adds exponential value to the business, right? To what you're doing and to yourself as a person, both professionally and personally as well. So it has been an incredible journey so far. And yeah, looking forward to seeing where this takes me in the next phase, hopefully.
Yeah, no, this is super interesting because you've been into consulting and investment banking, and also you worked as an operator and now as a founder. Do you think before you start a company, should one work as an operator, or should one work in a large company or in a tech startup? Does it really help? And what was some of your biggest takeaways from working with deposit solutions?
I think it's a great question. I think it's definitely something that I would always encourage people to do if you're looking to start something from scratch. I think, especially if you come from a professional services background, where, I mean, consulting, investment banking, and so on, is very fancy, very formal, very, amazing for the network and everything. But you work with very, very smart people that work really hard and very fast. And I think it's just not representative of the real world. I mean, I always say that like people in these kind of places are kind of like racehorses that you don't need to motivate them every day. On the contrary, you need to like basically stop them and send them home and then just get some sleep. And that's just not, I think, representative of like the entire like world out there. And I think the other thing is that you also like, I think, need to learn what it actually means to work on real like operations, on owning a P&L, on knowing what it is to actually like create a product, a service, put it like commercialize that, distribute that, negotiate with vendors, negotiate with clients, negotiate contracts, hire people, build a team, motivate people. I think like being in a scale up or in a bigger tech company that has all these elements, I think is really helpful to really get into the how a company functions, right? And what are all the different elements that you need for a company to function. Because the reality is, very early on, when if you start something from scratch completely as a founder, I think you have to do absolutely everything, right? And there's nobody there to tell you, oh, this is what you should be doing, or hey, actually you missed this or that. And there's no structure. It's not like you pick up the phone and you call HR or you call IT because your laptop broke or you have an issue with your phone or whatever your IT setup. You're really, really on your own. And I think that really requires a lot of, I think, resilience and energy, both, I mean, physically, but also emotionally. I think it can be quite lonely initially. And I think like having that like backup, or not backup, but maybe like background where you say, hey, I know what it like. I worked in a good brand company. I have a network. I feel it gives you kind of like a little bit, I think, like within all the uncertainty of building a startup from scratch, I think that kind of previous experience really helps you to give you a bit of confidence, credibility, not only to yourself, but also in front of the investors, in front of potential partners. I think that is really important. And it will just allow you to be more efficient and I think better at building your own company. Having said that, I also don't think like if you feel, I think like starting something from scratch is not for everybody. I think it is, there's no right, the way I always see these things, there's no right or wrong in life, right? I think like you just need to know who you are and what is important to you and what you have fun doing. And because obviously starting something from scratch is very intense. It's very stressful. It's a huge emotional roller coaster all the time. And that's just not for everybody, right? I mean, some people really thrive in that and really have fun doing that. And some people would really suffer through that, right? So I think like you need to know who you are and if that fits kind of like your personality as well. So my point is, I think like if you always felt that like itch of wanting to start something from scratch and be a founder, then I also think it doesn't make sense to spend like 10 years or 15 years in a bigger company, a corporate, or in consulting or investment banking before you actually try something, right? So I think like the bottom line for me to answer your question is it's something in the middle. I think it's always good to do some like experience in a bigger company, whether it's a tech scale up, whether it's a consulting or any professional services company. I think doing that at least a few years before you start something from scratch, I think is extremely powerful, because it will give you a lot of network. It will like really like teach you how to work structure in a very structured way, and those are key elements for when you start a startup, right? Because there's, as I said, there's zero structure, there's zero anything when you start. So you have to basically impose all of that discipline, all of that structure to yourself. And having previous experience in how to do that really comes in handy.
Yeah, no, absolutely. You put it right. There's no right or wrong answer, and it depends on the personality of a person. And you know, I'm coming back to auto finance. I wanted to understand, how do you vet financial coaches, and is it like a marketplace where you vet financial coaches and you connect them with employees?
Sort of. So basically, what we do is we onboard with an employer that is interested in offering financial health as an employee benefit to its employees. And then basically what we do, like in a very, it's super interesting, because we onboard, we then send an invitation to the employees, to the selected employees. Those employees basically get that invitation to onboard onto our platform. We run them through kind of like what we call a very seamless and gamified onboarding journey, where we built a financial and risk profile for these, but more than anything else, it's kind of like a financial profile for these employees. And on that basis, we match them with a financial advisor, a financial coach, that then basically we allow them via the platform to connect with, to schedule to book a session via Zoom, for example, with a financial coach. Then once they build that relationship over our platform, they get a financial roadmap that is targeted at basically helping them reach their financial full potential, giving them the peace of mind that their financial lives, their personal balance sheets are completely are under control. And from a very holistic perspective, right? That basically it's not only it's having all your bank accounts, your trading accounts, your insurance, your pension, everything really in all your assets or your liabilities, everything in one place in real time. And we use Open Finance for that. And then you add a few layers of smart tech, of AI, to extract insights and recommendations from your personal financial profile. And you are paired with your own financial coach that basically will help you say, actually, look, given your profile, you should probably be doing this or that, or there's this or that benefit that you're not taking advantage of, and so on and so forth. But really kind of like, if you take a step back, it's kind of like being your financial doctor, right? Like just making sure that you are doing everything you should be doing in your financial life, that you are protected, that you have everything in place that you need to basically enable the lifestyle that you want to live over the long term.
Got it. And I've been part of a travel marketplace called OYO Rooms, and I wanted to understand, when it comes to supply and demand, how did you solve the classic chicken and egg problem when you're trying to? What did you look at solving first? Getting employees on board first, or getting the financial coaches on board first, and how did you look at solving that problem first?
Yeah, so basically we first started, it always is kind of a chicken or an egg problem. I think it always happens when you start something from scratch. But the way we started to, we did a lot of user research, a lot of prototype building and prototype testing. Then we started onboarding, like hiring and onboarding financial coaches, and then doing like family and friends testing, like so the coaches giving us and our family and friends sessions and seeing how the onboarding works and everything. And only after that, basically, we started onboarding real customers. So I think like the short answer would be first everything that basically the product needs to be a real product, right? Like build a platform, everything from basically onboarding to like integrate all third-party integration, security, data, and so on. Then bring on the financial coaches, link their calendars and everything to our platform, and then only when that is completely ready and tested, then you start onboarding like real users. Because the reality is also like with these kind of products, right? Like you don't get many shots, right, to make them happy and to get them to test the product. So if you don't want to basically use your bullet if you're not completely ready to do that, right? I think like that's something that's very important, especially in B2B, where it's not like I can just burn all these bridges and then I'll just like invest more in marketing and then just get more and more users because there's millions out there, right? That doesn't apply to B2B, right? I mean, B2B, it's the sales cycle is much longer, way more effort, way more personalized, and hence need to be way more structured and like thoughtful in terms of how you approach that.
Got it. Thanks. And I had Faris Grinda from FC Labs who focuses on marketplace products, and he talked about building moats around your business. How should fintech and marketplace founders be strategic in building moats around their businesses, considering that there've been a lot of B2B platforms which have come up, especially in the fintech space in the last couple of years. What is your framework when you look at building moats?
I think the way I completely agree that you should always think about like what is a sustainable competitive advantage that you're building, and always have like that view like early on. And for us in fintech, it's first of all, that's why I want to go B2B and not B2B and not B2C. I think I don't like business models where your growth is basically linked or immediately linked to your marketing spend. I think that's very easy to compete with. I think in B2B, you have like already inherently like higher moats, because once you, as I said, I mean, sales cycles in B2B are longer and more difficult. But once you get them, you cannot copy a corporate partnership, right? That takes a lot of time and like an effort to develop and to sign and to get on board. And it's not something where somebody can just by throwing some more money at the problem or spending some more in marketing, just copy that, right? So that already creates moats. Then on top of that, you want to create a business model where customers and clients have high switching costs and a lot of stickiness, and that happens in businesses where, I mean, not only obviously B2B inherently, but also where you build a relationship with the user. And that's where the B2B2C comes in, because your go-to-market, your distribution is B2B, but your brand equity is B2C. So you're not a white label integration into a B2B. You actually have a brand that the user sees and feels and interacts with. So basically, it's not easy for the corporate then later on to say, oh, actually, like two years down the line, this other provider comes along called Johnny Doe, and Johnny Doe just does it like 10% cheaper. So we're going to replace you by Johnny Doe, right? For the employees, it wouldn't be the same, right? The employees would be like, whoa, I don't want Johnny Doe. Like, I built a relationship with Otto Finance, for example, over the last couple of years. And I want to keep that. That is really important to me. So just like, I don't care if you can like save 10%, right? That kind of like brand relationship creates stickiness. The fact that you build a relationship with your human financial coach as well creates stickiness. You invested time and effort in building that relationship also from your end and telling them about your life and in like actually like going down the financial roadmap that they built, that our platform built for you and so on. And you just don't want to lose all of that effort that you did later on just for somebody that's maybe a bit cheaper. So that and on top of that, like when you have like, if you are making employees happy and hence HR people are happy, then they have no reason, right, to look at other alternatives, or they would be very close to like competitors coming in and saying like, hey, I want to completely change your provider, which is a big headache always for a B2B, right? So I think like if you manage to build like strong relationships, make customers happy, and have a brand and have some real B2C brand equity, I think you have very strong moats. Plus, if you get network effects, right? Because the more data you have, I mean, the more users you have, the more data you have. The more data you have, the better algorithm you evolve, and hence like a better platform that I guess smarter at like extracting insights and recommendations from financial lives for your users, and hence improve the app even more, right? The platform even more. that's super high network effects that are very difficult to copy.
Yeah, no, absolutely. I think using data to as a network effect to grow the company is a great example. But I understand that Otto Finance would be collecting a lot of data points because they're mapping the financial coaches with their corporate employees. But do you also look at data to acquire customers? And how would you look at data to acquire customers, especially in the B2B space?
Well, I think that what you need to do is you need to, data by itself doesn't have any value, right? It's like basically how do you use that data? How do you extract insights from that data, right? And I think the insights that you need to focus on is what are pain points? What are problems? Like you, at the end of the day, users or all of us, right? Like we care about stuff that solves a pain point, that solves an issue, a problem, or anything in our lives, right? That's what we care about. So like, I think the insights you need to focus on is this helping? Is this solving any pain point? Is this helping my customer, my employee in any way? Is it making their lives easier? Is it taking a load off? Is it giving them peace of mind? I think that's the kind of like data you want to, or insight you want to extract from the data, right? Like understanding what is this data saying in terms of pain points, in terms of like potential solutions for these pain points. I think that's how like the only way to use smartly that data that you get, right? And I think like also sometimes it's just people, you obviously you say, okay, data is the new oil, and so just like the more data the better and so on. But I think that's also like not universally true, right? Like you cannot just like get data for the sake of getting data, right? I think that's even basically shooting yourself in the foot, right? Because you're just going to get like way more stuff than you actually need, and which not only entails actual like risks in terms of like security breaches and so on and reputation, but that's also adds complexity to your business, right? So you need to like, I think, have an answer first kind of approach where you say, okay, what are the questions I want to answer, right? And then, okay, what is the data that I absolutely need to be able to answer these questions? And then you go and get that data, right? You just don't do like just a blind data point where it's like basically, okay, I'm gonna try to suck up every possible data point that I can, and then see what I do with that, right? Like basically boiling the ocean. I think that's how I would go about it. Like really, especially when with business models that relate to very sensitive and personal data, like your personal finances, I think you need to be very mindful and very careful with what kind of data you actually get, what kind of data you want to store, and so on, because you have huge like damage potential, right? So it's not just like you need to be very, very conscious about what is the minimum amount of data you need to be able to solve that problem, or to like feed your algorithm, right? To improve your platform, your product.
And when it comes to fintech companies, is it possible to direct consumer, redirect consumer behavior through incentives or through social pressure? Because I worked in a SaaS company where we used to incentivize people real time and give them rewards and recognition. But I was wondering, is it possible to use social pressure to influence consumer behavior?
I think it is, but I wouldn't do that. I mean, not at least in our kind of in our business line, because you don't want to push people to do anything, or you don't want to have to force them, or you don't want to like pressure them into do anything, right? I think like that's exactly the model we want to disrupt. If you think about traditional financial advice, right? I mean, financial advisors, traditional wealth managers traditionally get paid by either transactions or AUM, right? So they will always try to basically push products and services down consumers' throats just to be able to increase their AUM, and like basically milk the cow, so to say, right? And that's why also there's this big mistrust of financial advisors and wealth managers, because you know that actually this guy's just trying to sell me something just to make more money. And I think that's exactly what we want to disrupt. So that's why our business model is that the employer pays a fixed subscription price per employee per month, so that we can really say, look, we are completely aligned in our incentives. Our only incentive to provide this financial health, this financial wellness to the employee is to make the employee happier and more productive. And if that's the case, then we are a success as a company. We don't make money by selling you products. We don't make money by selling you services. We don't make money by increasing your AUM with us, right? We don't manage your money. We just We are there for your peace of mind, to help you like get a grip of your financial life, and just like make sure that like the way you're handling your personal finances will enable the lifestyle that you want to live, right? That's what that's our mantra, and that's how we want to be seen as well. Sometimes actually it's even not doing anything, right? Like the opposite of pressuring users to do something, right? Sometimes it's actually users are, we did a lot of user research, and sometimes it's just about like giving that reassurance to users that, hey, by the way, like we took a look at your financial life, at all your trading accounts, your investments, your insurance policies, and so on. Like you're doing everything you should be doing. Everything is on track. So don't worry. Focus on your job. Your financial life is everything is taken care of, right? And that just, again, you didn't sell any product or any service or anything, and you had the result, the outcome that you wanted, which is basically giving the user that peace of mind, that like basically allowing him to like not have any financial stress, and not have any worries or any kind of thoughts about, oh shit, should I be doing something on like here or there? Like, am I do I have FOMO on this or that? I read about crypto, I read about this. Should I be doing something? Am I missing a train? And if you maybe you have somebody say like, actually took a look and you're all fine, you're all set, don't worry, just go about your life. That already has a huge value add to the user, and you didn't push him to do anything, right?
Interesting. And I've been a part of different industries, especially when it comes to travel and direct to consumer B2C brands. But where influencer marketing is pretty common. But do you think influencer marketing could be a common phenomenon in financial industries where a lot of Gen Zs and millennials look up to influencers? But do you think influencer marketing can also be an acquisition channel going forward?
Oh, 100%. I think it's definitely something that will come, especially for, as you say, for Gen Z. And especially as financial complexity increases, right? Because if you think about it, like 30 years ago, I mean, people, your savings, you could even invest in boring stocks or boring bonds, right? Like basically either fixed income or equity stocks in companies and in traditional markets. That was basically the extent. Or you bought a house and you put your savings into like some real estate, right? Like your own house, your own apartment, etc. That was basically the extent of stuff that you could do, right? Like not that much complexity. If you think about the evolution in the last 30 years, now people can invest in, I mean, first of all, like access to investing in like tiny stocks in stocks around the world, with a very global perspective, has been democratized. You have like access to derivatives. You can access, now you have like crypto assets as well. You can invest in NFTs. Like the complexity of stuff that you can do now with your personal money, it just increases, right? At some point, access also to alternative investments like private equity or VC funds and so on will also be democratized. And I think the fact that like there's more and more stuff out there that you can do will lead also that like you want to know like okay, who should I like just listen to, who should I follow in doing this, because it's just basically too much for me to handle on my own, right? So you'll pick somebody that you trust, and then you start following that person and saying, okay, if this person that basically I trust and has a profile like mine and has like goals like mine, etc., if he's doing this or that, then like it makes sense for me as well, right? So I copy either their trading strategies or I follow their recommendations and so on. And I think that will definitely come in as a trend in the.
And while we're talking about Gen Zs and millennials, I want to understand how do they plan to spend, save, and invest money? Do we get some insights from this particular generation, especially the Gen Zs, because they're going to come into the workforce and be the next future leaders? How do they look at money and investing?
That's a very interesting question, and given the user research we did, I think what is more and more the case, first of all, people like generally, especially Gen Z and millennials, like everybody wants to retire earlier. So or at the very least, like I think what's valued a lot by these users is, or by this segment, is optionality. And it's not necessarily wanting to retire earlier, it's having the option and the freedom to do so. especially as Gen Z employees like switch around companies way more, really appreciate or value the flexibility and being able to remote work, being able to take a month off, maybe leave of absence to go travel for 2 months to focus on my family, on my personal project, and so on and so forth. I think the Gen Z really values that flexibility, and hence, I mean, as I was saying before, right, that's where we come in as well in terms of like your personal finances or your personal financial life should be an enabler of that lifestyle that you want to live, right? Whether that's retiring earlier, whether that's working 80% in terms of or instead of working 100%. I think what Gen Z people want is that, right? It's basically, okay, is my financial life going to enable me to live the life I want to live, or will I have to work like 9 to 5 until I'm 65 and able to retire and only have like a couple of weeks holiday per year that I'm entitled to given my company and so on. So I think the way I see it is what is really important for these users is flexibility. And having like that, knowing that their financial lives are basically on the right track and that they're doing everything they should be doing to basically enable that lifestyle that they want to live in the future. I think that is the key. That is a key point. And kind of like living less on the day to day.
Right. Yeah, no, absolutely. It's very interesting how the Gen Z generation, behaves. And, as you rightly pointed out, they look at optionality and freedom. When it comes to, I want to talk about metrics, do you look at GMV as a sole metric, or do you look at other metrics which help you measure yourself against other competitors?
No, I think, GMV obviously makes a lot of sense as a KPI, but in other businesses, right? Not in our business, especially not in FinTech. Generally in FinTech, you either have transaction costs that are your revenue stream, or you have basically basis points on AUM. So you either like charge per transaction, you charge per AUM, or you charge a subscription to access a service like in a kind of like unlimited way. So I think like that's how that's the metrics that we look at. I think like one is uptake and penetration, because obviously, especially if you are in B2B and offering something to employees, like 100% penetration doesn't exist, right? So like you will not, given that when you sign a deal with a corporate and then you give access to something to their entire employee base, an employee base is always by definition very diverse, right? Different seniority, different backgrounds, maybe even different locations and so on. So it's very difficult. It's very difficult that you have one product that like absolutely fits everybody's needs within a company, right? Because again, by definition, the employee base will be so diverse. And hence penetration is very important, right? Because even if you manage to sell something to a corporate with a complex B2B sales cycle, but then you only have like, you could be like maybe the best B2B business development guy ever, but then if you have 10% or lower penetration, then obviously within the workforce, then you're not relevant at all, right? And then at some point the corporate will say, actually, like, all great, but like, why should I continue to pay you if so few users or so few employees of mine actually want to use this? So I think when you do in these kind of like businesses, you have kind of like two like KPIs are very important, not only in terms of like the sales the corporate sales that you do in B2B business development, but then you have like kind of like two sales cycle, right? Because you have first you need to sell and sign the contract and the deal with the corporate, but then you also actually need to sell it without actually having to like ask money for it, but like you need to sell it also to the user, right? To the end user. And I think in businesses, I think GMV is not relevant in businesses where you have basically where it's a different person that pays you than the person that actually uses the product, right? Because in the B2B space, basically the B2B, the business is paying you, but the end user is actually using the product, right? So you need to like create something that is super relevant for them to actually engage and want to use the platform, and create enough value to them so that they in turn tell the corporate, the HR, hey, actually this app is amazing, this platform is amazing, it's adding a lot of my value, so definitely I want more of this, not less. And then in turn that makes a corporate or that like increases the willingness to pay of the corporate for the solution, right? So I think for us, metrics is penetration, is so penetration, user engagement, like MAUs, monthly active users, and so on. Because again, like the revenue stream, when you have a subscription model, like it doesn't matter, like the GMV doesn't matter, right? Because you're not selling products or services. Not like where like Deliveroo or like food delivery businesses where GMV is the key metric, right? Because it's a leading indicator, and then you have all the lagging indicators after that. If your GMV grows, then everything will grow after that, right? And similarly, when in a subscription business is what the ARR would be, or the MRR, right? Like as a leading indicator. So that's kind of like, I think like the key KPI is your ARR, because that's also what investors like will look at, right? But yeah, that's basically the bottom line.
Yeah, no, absolutely. I think it's mostly for marketplaces where they look at GMV, but you're absolutely right. Penetration and MOUs is what you would look at. And you backed by a Flash Ventures, and you had other investors who joined you. How did you make like you mentioned initially that you spoke to a lot of investors and you decided on you want to onboard and work alongside these investors. How did you select the investors that you finally got them on board?
In terms of, just to understand the question correctly, you mean in terms of how do you sell to investors, or how do you work together with investors?
Yeah, I mean, how did you choose to have those investors on board?
Oh, so that's a great question. I think for me that was really, really important. So I really took my time. I spent a few months working together with investors on the idea, on the scoping, on the market research, the due diligence, and so on, to also see how it is to work with them. Because for me, I think like when you were really early stage, your investors are key, right? Because you like probably even just the money is even I think like not even the most important thing they give you, right? It's about the help, the network they bring on, the experience they bring on. It's basically because they're getting from 0 to 1 is really, really difficult, right? So having a partner that can like be very active in helping you get there, helping you recruiting, team building, and all of that is extremely important, right? And it needs to be fun to work with them, right? It needs to be engaging and fun to work with them. And because again, like in this early stage, you will work very closely with your investors. It's not like later stage where basically the investor gives you money and then like, okay, let's have a board meeting every once in a while. And then like, let's see how you do. But like in the meantime, I'll leave you alone. I think early stage, you need to work very closely with your investor, and hence it's almost like them being part of your team, right? And not on a day-to-day basis, but like very close to it. And hence I think the human value, the fun element of it, of working with these guys, respecting them, admiring them as well, and them adding value on your day-to-day with like experience in operations, experience in team building, experience with like, or like giving you access to their network. That is absolutely critical, right? Like much more than just giving you money. And I think that's something that I really put a lot of value on, because it can make all the difference. Like just giving you money. I mean, maybe you spend the money in not the best possible way, and then like you don't manage to actually raise more in seed or Series A. I think the biggest help they can give you is in everything else that comes other than the money.
Yeah, no, absolutely, absolutely right. Especially in early stage, becomes very important for the investors to guide you. And I quickly want to do the top 3. What's your favorite business book?
My favorite business book, actually, that's a great question. The one I recently read, I think it was, I really liked 0 to 1 from Peter Thiel. It's a good one. Especially, I don't like long ones. So, because especially when you're starting something, right? Like you're so busy and your days are so long that you just don't have the time to read a 400-page book. You need like very short and crisp and stuff that goes to the point. So I think like I like that book because it really, I mean, it's relevant to my stage, 0 to 1 by definition. And also like written by somebody that actually knows what it takes to do 0 to 1. And then there was, I forgot, like there was this other one that I actually really liked, and I forgot now the name. But I really liked it as well. But I think like it's short books written by successful entrepreneurs that really like go like really straight to the bone of what matters and what doesn't matter. I think that's super important. Actually another book, like, and it's not so related to actually like venture building, but I think like it's definitely like around the corner. And it's a great book. I mean, the name is a bit weird. It's called The Subtle Art of Not Giving a Fuck. And it's a great book because it really, especially I mean, you can relate it to anything in your life, right? But like I related it a lot to the early stage venture building, because like really you have so many things on your plate when you're starting something from scratch, that it's very easy to like get lost in a world, in a universe of details, and saying like, oh, this and that, and you get basically worried about everything, right? And I think sometimes that book was a good reminder of like sometimes taking a step back and saying, wait, what are the key things that I actually should be like caring about, right? Like, okay, these are the three elements, and the rest I can like, I shouldn't be giving like a fuck about this, like the book says. And I think that's sometimes a very good reminder, because again, I think like in early stage venture building, you have so many factors, so many variables, so many elements to worry about, that if you worry about all of them, you're just gonna be paralyzed. Like you're not gonna make any progress. So being able to like see through like that forest, right, and see, okay, what are the trees that I actually need to care about and spend like energy on, is absolutely key.
Yeah, no, absolutely. We'll put that the books on the show notes. And if you could go back in time when you started building Auto Finance, what is the one thing you would have focused on or done anything differently?
I think I would have probably I think I would have probably spent a bit more time on user research before building. I think sometimes you have that, like you have investor pressure, you have like market pressure to just like ship out a product, and sometimes I think like if you then have to change more stuff later on, it kind of like becomes then more inefficient later down the line. So I think like sometimes saying like, hey, I'm gonna take these extra weeks to do a bit more user testing, a bit more prototype testing, fine tune that a little bit more, and then go all the way into build and then marketing the product. I think it's just really being like sometimes knowing when to say no and push back to investors and to everybody else who's pushing you to go faster and to like just ship something to the market. I think that is something where I probably would have said like, okay, wait, like actually we could have avoided these like 2-3 iterations once something is already built in the prototype phase. And in the prototype phase, everything's easier to like correct and iterate on than when you actually have already like a real product that is built.
Correct. And do you have any favorite online tools, for example, Gmail, Slack, Zoom?
I think Slack is my favorite one. I think if I think about it, Slack is the first thing I look at in the morning, and it's the last thing I look at in the evening, because it's like wrapping up with a team, seeing what's also like having it integrated with my calendar. So I see in the morning, I actually see on Slack what meetings I have that day, and the notifications I get. I see like who needs something from my team, and same in the evening, right, for the wrap ups and so on. So I think that is that's the tool I like the most.
Sorry, we'll put that in the show notes. Jan, what is the best way people can reach out to you and know more about Auto Finance?
Basically, they can write to me on jan.thomas@autofinance.io or reach out to me on LinkedIn as well. I'm quite active there.
Sorry, we'll put that in the show notes. Jan, thank you so much for taking your time and speaking to us. I really enjoyed my conversation with you.
Likewise, was a very fun conversation, and happy to always help. I used a lot like networking and speaking to people before building a venture, and I think that always helps. So very happy to do that for other people as well.
Thank you.
Cool. Have a great day as well.